Kevin, and hello, everyone. Kevin, first and foremost, thanks for allowing me to participate on a topic that I have worked in, and have talked about for probably 25 years now in the industry with Chapel Bridge, with business owners in multi-industries, and specifically with Gladstone in financial services. What I'd like to do today, and as part of my discussion, is I'm not going to drill down on specific ideas or specific thoughts, but I think the way I want to approach today's conversation is the need, not only the need for succession planning, but as we look at the statistics in our industry, the lack of firms that actually have a succession plan in place. And I think that starts with a misunderstanding of the term succession. In our industry, you open every trade journal, you attend webinars such as this one, you go to conferences, we are inundated with this term succession. How am I eventually going to hang up my cleats and walk off the field? And I just recently published an article that succession planning is one of the dirtiest words in our industry, because frankly it's misunderstood. If you look at the word succession and you look at the key word in the key part of that word, it's the term success. Success is, how do I define success for my business? What will my ultimate future look like, and how will my firm be successful moving into the future? It is part of that plan is, how do I exit? How do I protect my business for an unforeseen event? But it's also, how do I grow my business? How do I develop my staff, my next generation of leadership? How do I maintain or create a competitive edge for my business? So today's succession planning conversation is going to be more about how do I think about it? Why should I start thinking about it? And as entrepreneurs, we look at our businesses, and it is one of our proudest achievements. First is our children, usually for entrepreneurs. Secondly, it is our business. We gave birth to it, we nurtured it, we developed it, and oftentimes our identity is attached to it. And one of the most difficult decisions as entrepreneurs is, how am I going to eventually let go? And as entrepreneurs also, we build our businesses most times being in control of every aspect of our operation, of our firm. But this is one area oftentimes we don't have control, or we haven't put ourselves in a position to have control. So the first question we always ask an entrepreneur in financial services is, have you created a business, or have you created yourself a job? You talk to most entrepreneurs in our industry, this is a first-generation business. And to give you a very dramatic statistic, according to the SBA, the Small Business Administration, who's been publishing the statistic as long as I have been working with privately owned companies, there is a statistic that only 30% of all entrepreneurial businesses will be successful in their first generational transition. That means 70% of all entrepreneurial businesses fail. Why that statistic becomes magnified in financial services, you're really looking at an industry, and I draw the point in time that the independent side of the financial services industry was really started back in 1979, when the first graduating class of CFPs got their licenses and set up their shops. And this is predominantly a first-generation industry. So that failure rate of 70% becomes extremely magnified. So the first question is, I started my business. I started as a practitioner to work with clients, find new clients, do their financial planning, manage their investments. But and over time, I may have wrapped myself in a corporate wrapper with staff, infrastructure. But the question we ask advisors is, the business that you built, is it you and only you, and everything is attached to you, or have you built yourself a true business that has transferable value? This old saying couldn't be more true when we talk about succession planning. A failure to plan is a plan for failure. The other way I put this statement is, by not having a plan in place, for all intents and purposes, you do have a plan. and to be very cognizant of a fact for folks who are running a business with a corporate structure and did not have a transition plan in place, and there was an event such as a death. A lot of time, most times, advisors do not realize that that business will then become part of their estate, and that business will transition according to their to their estate documents. And sometimes we get looks of concern, sometimes we get chuckles when they begin to realize that their spouse will be in control of the business. And I've even heard the comments sometimes as a tongue-in-cheek that my spouse doesn't even know where my office is, but they will be in charge. First, as we look at succession planning, we look at long-term planning, and really, I'm going to stop using the word succession, start talking about this as corporate planning. The corporate planning, if I'm building a corporate plan, the first aspect of the plan I begin to look at is what is the state of our industry. For a number of years, I was continually saying the industry is changing. The fact of the matter is the industry has changed. As entrepreneurs in financial services, I think we would all agree that the future is going to look much different than the past. It is becoming more costly to maintain and operate an independent business from an infrastructure standpoint. The regulatory environment is becoming extremely complex, whether it is going to be the DOL, the SEC, or FINRA. Everyone is under agreement that these organizations would rather have fewer firms than more, and they're making it, again, more costly and more complex to remain an independent firm. Also, you begin to look at these businesses, and for businesses that manage assets or manage investments, and their revenue is based upon the management of those assets from a fee basis, most oftentimes their revenue streams are correlated to the performance of the marketplace. What this means is their revenue is variable, but oftentimes their expense structure is fixed, getting more costly, which is now we're seeing in many financial services firms profit margin compression. When we started Gladstone 11 years ago, we were working in the RIA industry. We would see RIAs with 40% profit margins. Large RIAs now we're seeing at about 19% profit margin on average. Lack of tools and insights. One of the greatest opportunities in this industry and one of the greatest concerns of our industry is the continual now influx of technology coming into this space. It is becoming very difficult for advisors to not only understand the current technologies, but stay up to pace with the amount of technology that is coming into the industry, from the way they manage and engage clients to the way they manage their back office and administration. Most advisors as well have a very little understanding of how they're going to grow value, buy, transition, or sell their practice. For most advisors, they have viewed the transition process as an event and has not viewed it as a process. This type of planning is a process, and they give everyone on the phone a very interesting observation about succession planning. We have found that they spend their entire careers diversifying their clients' risk in their portfolios, meeting with them on a quarterly basis, the risk adjusted so they can meet retirement goals. When it comes to advisors, as entrepreneurs looking at their transition in their business, they typically wake up at 7 o'clock in the morning, realize that they have a concentrated stock position that represents almost 95% of their net worth, produces 95% of their income, and they want an exit plan put in place that is effective and successful by 4 o'clock in the afternoon. It doesn't happen. Succession planning is actually a series of plans that are built over time to reach an ultimate outcome. It determines how you're going to transition, when you're going to transition, to who you're going to transition the business in order to protect your family, your clients, your staff, and the legacy that you have built. I talked a few minutes ago about the failure rate of entrepreneurial businesses transitioning hands at the first generation level. To further emphasize the point, when we started Gladstone 11 years ago, the number of firms that had a succession plan in place was 20%. Fast forward 11 years, after all the publications, seminars, webinars, talking heads debating it, that number is still 20%. So as we sit back, the question we have is, everyone knows they need a succession plan, but why hasn't that statistic changed? And I'm going to address that in a few minutes on some of our thoughts, why there's still such a low percentage of folks that have succession plans. Another staggering statistic as part of this number is not only is there a lack of long-term succession planning, there's a lack of an interim plan. As we go through this conversation today, I want everybody on the phone to think of succession planning as not one plan. It is actually two plans. It is made up of two very distinctive plans. One plan is your exit plan. How do I retire? How do I transition my legacy? The second plan, which I believe for most advisors in today's business, in this environment, is more important, is the interim plan. What happens should I not show up for work on Monday? What is my interim plan? What protects my business, my staff, my clients, and my family against an unforeseen event? The two dramatic unforeseen events we all know on this call is death and disability. The likelihood of becoming permanently disabled is more likely than death. So how do we have a plan in place that at least addresses those two unforeseen events? Growing need for building transferable value and back office efficiency. One of the area I point to here is you look how these businesses have been valued, or historically the rule of thumb misconception. And I say this as misconception, how businesses are valued in this industry. For years we have heard, entrepreneurs have heard the businesses trade on multiples of revenue. Everyone probably knows the average. Businesses trade between 2.1 to 2.5 times recurring, 1 times non-recurring. The fact of the matter is that is untrue. Businesses trade on the predictability, viability, and stability of your profit or your cash flow. If I'm buying a business, if I'm investing in a business, or if you're doing research on a stock selection for one of your clients, you will look at the revenue, but what's more important to you is what's the viability, stability, predictability of that profit stream and cash flow. So as we begin to look at businesses, what we begin to quickly realize is, how do I create the most efficient back office, control expenses while growing my revenue to create the most profitable, sustainable income stream? A few minutes ago, I also said that variable revenues, fixed expenses. I want to clarify that a bit. I talk to many RIAs, and the RIAs will tell me, no, my revenue is not variable because I charge a percent of the assets I manage. That is also a misnomer. Your revenue is actually variable because if you are highly correlated to performance of the marketplace, as we all witnessed in 2008, the market takes a drop 25%, your revenue has dropped 25%, but your fixed costs have remained the same. We're seeing many firms now begin to look at their expense structure and asking themselves a very important question. What is necessary that I have in my house, and what can I outsource? What expenses can I outsource to make them variable? We boiled 3 statements down, and there's only 3 statements. And these are the inevitable decisions. Every entrepreneur will face one of these decisions going forward. Have I properly planned for the management or perpetuation of my business in the event of an unforeseen occurrence, such as death or permanent disability? Remember something as you think about this. You have run a business typically smoothly. You have a good culture within your business. The day you do not show up to the office, you're asking your internal staff to not only maintain the clients, but you're also putting them in a position in a time of chaos. They will be dealing with your departure. They will be dealing with your family. They will be dealing with your advisors, in addition to maintaining the business and trying to keep the businesses viable. A statistic for you: within the first 90 days of an unforeseen event without a plan, there is over a 50% value erosion. Second question, how and when will I perpetuate the business into the future while realizing value for what I've built? As entrepreneurs, and I will include myself in this point, the reason I started my own business years ago was because it's my passion. It's my hobby. I enjoy doing it. I don't have many hobbies outside of my business. Somebody you would not want to go golfing with. So it's very hard for me to think about how am I going to exit the business. To give you a story, my father ran a construction business for many, many years. He transitioned the business 5 years ago, and I was recently talking to him, and I said, Dad, how's retirement going? And he said, well, he said, for years I was the king of the hill. I used to walk through the shop, and I said, a trash can is full, and I would have 5 people wanting to empty that trash can. Now I say the trash can's full, and your mother says, yeah, go take out the trash. So it's a part of our identity. It's a part, we have authority. We are the top of the top. We don't answer, so it is very hard to think about how am I going to pick a point in time to say it's time for me to leave. The point I am making is you don't have to have an exact date. You're not working for a large company where your retirement age is 65, but you should have 10-year time bands that says in every 10 years I'm going to reevaluate myself in my business and determine how much longer I want to do this. Big question for many advisors right now is how do I continue to effectively grow and scale my business to ensure a more viable, stable, and profitable firm? Pointing back to 10 years ago when we started, I could count the number of billion-dollar firms on one hand. Now I need to be an octopus. I need to count as many billion-dollar firms. When I talked earlier, the industry is changing. We're seeing now industries being changed from lifestyle-type businesses to real enterprises. They're being run by companies. They're being run as businesses. As a matter of fact, some of the leading executives of these businesses are not advisors. They're professional executives. They're CEOs. They're presidents. And everyone right now is racing for scale. Scale to do a few things. One is to create a competitive advantage for themselves. The second is as a defensive approach. As you get bigger and reach more scale, you become more. You have more infrastructure. You have more critical mass, which would equate to you have more sustainability, and you are a more stable business. It is also getting harder to find and attract new talent. There's a lack of young talent coming into this space. So we are seeing this year, last year, and coming into this year, a major uptick, not only in acquisitions. Firms are looking to not just acquire assets, but are also looking to acquire and assimilate new talent, systems, and processes. Our merger conversations are up 20% over this time last year, as many advisors are now looking at their businesses and saying, I don't want to exit, I don't want to leave. But, however, there was a firm that I know, we do things very similar. If we come together, perhaps we can not only create synergies, solve some of our mutual concerns, i.e. succession or transition planning, but we can also alleviate or combine some of our cost structure. Many reasons to delay. This is the crux of the conversation. 20% of the industry has succession plans. 70% of businesses fail. Most of these businesses do not have an interim plan. So the question becomes why we hear the noise, but we're not acting on the need to put a plan in place. The first, I'm not sure who to call or how to start the process. As entrepreneurs, we wake up every day doing one thing. We want to work with our clients, and we want to find our clients. We look at succession planning as a distraction. On our to-do list, oftentimes it's number 11. Also, a frustration for many entrepreneurs is when they do reach out to get help on their planning, they're hiring consultants that have little experience in succession planning. They talk about it, they read the practice guides, but at the end of the day, they do not have the experience to effectively implement a succession plan. The other problem is, with a lot of times with the consultants, The clients will hire a consultant. They will come back with a playbook or a strategy book, hand it to the client, and say, here you go. And now the client is left to his own devices to put that plan in place. And what that plan does is become a paperweight, become a coaster for their coffee. So who do you call? Start with your attorney. Start with your accountant. Start with finding out who your peers have used in the industry. Talk to your custodians. Talk to your broker-dealers. Worrying about being fair to all potential successors. This is a relationship-driven business. Oftentimes, the staff, the key executives, have been with our clients for many, many years, and they've treated them fairly, or sometimes they even treated them equally. And now they're put in a position where, how do I pick a person or a group of people to take this business to the next level and be my succession plan? You can be fair, but remember something, you cannot always be equal. And what entrepreneurs will typically often do, which is a mistake, is they think they can find a successor who looks just like them. The reality is entrepreneurs wear many hats as an entrepreneur. We're visionaries, we're strategists, we're great business developers, we're great client relationship people, we're analytical. To find one person that carries all of those traits is very difficult. So your succession plan may be a combination of people to combine those skill sets. The other important aspect to finding a successor is there's a specific DNA that all entrepreneurs have. I make a statement that unsuccessful entrepreneurs take risks. Successful entrepreneurs take calculated risk. There is a DNA in entrepreneurs that oftentimes we will make a decision with 50% of the information, and we will understand our calculated risk. Just because your next generation is a good investment management person, is a good financial planner, a good relationship person, doesn't necessarily mean they have the characteristics, skill set, or the DNA to be the entrepreneur. They may maintain the business during an event, but entrepreneurs want to say something very clearly to me. I don't want somebody to maintain my business. I want somebody to take something I have grown and built and nurtured and to take it to the next level. Fear of possibility of straining interpersonal relationships. This one is part and parcel with the previous slide. I'm going to begin to make decisions within my firm, and I am afraid that I will strain those relationships because I'm going to be telling a group of people or a person that they are my next-gen successor. How do I manage the folks that are not going in line for ownership or my succession plan? Take comfort in the fact there are ways, there are mechanisms to incentivize, motivate, and retain non-owner executives during a transition plan. The concern about how to acknowledge key personnel in the management team and value contributors to the business who should be retained but are not in line. I mentioned this one in the previous slide. Discussing difficult financial matters, personal goals with other outsiders because it's too private, somehow unpleasant, or considered taboo. I interviewed a gentleman some time ago at Gladstone for a position, and it was a young fellow coming out of Wall Street, MBA, probably could build a spreadsheet better than anybody in my entire office. And during the interview process, I asked him a key question. As we're going through, I said, "You have a degree in psychology, correct?" And he said, "I don't understand your question." I said, "You're a therapist, correct?" He said, "I still don't understand your question." I said, "I appreciate your experience, your education, your analytical skills, but we are dealing with entrepreneurs. Entrepreneurs, their decision to transition their business or to put a plan in place is an emotional decision. The emotional decision, they will be asking themselves some very tough questions that they either have not thought about before or have ignored for years. You must be able to manage emotion. Transition planning is an emotional roller coaster. And when you leave it to 7 o'clock in the morning to have an exit plan or a succession plan in place by 4 o'clock in the afternoon, the reason I say it takes time is the emotions can become overwhelming, and oftentimes we will see entrepreneurs pull back. They begin to realize that they haven't built their separate asset base outside of the business. The majority of the net worth is tied up in the company. They begin to realize they haven't set a stage for their next chapter of their life and what are they going to do the day after they put the plan in place and exit the company. The owners may not wish to retire. This is an interesting one. We've had this conversation more and more with advisors. You as advisors, you wear two hats. You are an entrepreneur, business owner, and you're an advisor. The misnomer is when we talk to advisors, they believe you have to leave the business as an advisor to succeed the business as an entrepreneur. That is incorrect. You can, as a business owner, you can think about how to begin to transition value, my equity, and realizing value for what I've built to get my risk off the table over a defined and comfortable period of time while still remaining an advisor to my clients. The statement I would make here is you can do that. You can be an advisor while you transition your business, and you can remain an advisor after you transition your business. Struggles to disconnect from the day-to-day urgencies to focus on long-term planning. There are many days as entrepreneurs we're happy to jump out of bed. There are other days as entrepreneurs we want to go back to sleep and pull the covers over our head. We are continually faced with the burdens of running a business. As entrepreneurs, it's a consequence of running our own company. We start out finding clients and working with clients, and over the years, we become the CIO, CEO, CTO, CFO, COO in many situations. We are the key decision maker. Everything runs through us most times. And it is very difficult to go to work that day and say, okay, I'm going to start doing my planning, but I have to put out these 8 to 10 fires before I can do that. So what that means is that succession planning conversation becomes number 11 on their list of 10 things to do that day. The way to overcome that is this becomes part of your strategic planning process. Strategic planning. How do I compete? How do I grow? How do I attract new talent? How do I incentivize, retain my existing talent? And how do I protect my business against an unforeseen event? And how do I eventually perpetuate this business? It is a long-term plan and a process. When you break it up in bite sizes, it becomes much easier to accomplish than trying to do it in one day. And the other fact of this as well is we have the tendency when we think about planning that we set out to do a very simple plan, and next thing you know, we're trying to address the next 15 years of issues within one plan. Do not compress time. Build little plans one at a time that are coordinated with one another, and guess what? You will reach a point where one day you'll wake up and sometimes not even realizing it, you'll have a comprehensive plan put in place. The assertion that because successors are not ready to assume control, nothing can be done. We see this more often than not. My successors are not ready. Some folks view, they won't say it, but it's actually a parent-child relationship. They view their successors as their children. They're grooming them. They're developing. And as parents, our children are just always not ready to take over, not ready to just do something. The fact of the matter is, if you begin to give them more responsibility, more control, they'll typically learn faster. The second piece of this, too, is if they're not ready and you give yourself time, you can put plans in place that will protect the business and control the business while that next generation is being groomed. The entire process seems too daunting. I think I've harped on this one long enough. It is if you leave it to doing it in a very condensed period of time. I'm often asked how long does it take to put a succession plan in place. My tongue-in-cheek comment, but which is a true statement for me, is you should think about transitioning the business the day you start it, because that's how you begin to plan for creating the most viable, sustainable, valuable, and transferable investment entity. The second piece of this, too, is in reality, it takes typically 3 to 5 years to put a succession plan in place. The longer you give yourself, the better the plan. And if you've reached the age of 65 years old, there is another statistic about entrepreneurs over the age of 60. If they have not done any planning to date, their likelihood of putting a successful plan in place is only 20% again. If you're a younger advisor, you're 45 to 55 years old, and you have an immortality complex, you may not be thinking of the next 20 years of exiting, but that does not take away the reality of an event. You should please protect yourself against an unforeseen event such as death or disability. The perception that it is a cost to be incurred with no immediate benefit. It's interesting. Business owners invest in their business every day. They put capital into their business to grow systems, to grow processes, to create scalability. They put capital into their business to go out and do acquisitions. They view that as an investment. They view this type of planning as a cost. The reality is this is an investment. This is an investment to protect the value and legacy you have created. And I want to touch on this for a second. I'll go back to this slide. We did a plan for a client 2 years ago. It was a rather large firm. The firm was started 20 years ago. One of the partners became very ill, was diagnosed with cancer, ended up being fine through treatment, but at the time it was a very scary event. That firm, when we walked in the door, had no planning done whatsoever. They had no operating agreement. Their corporate structure wasn't reviewed since the day they started the business. They had no insurance in place. They really did nothing to that point. All they had was a promise to pay the spouse a certain percentage of profits should something happen to the partners. That also was not in writing. We evaluated the situation. We came back. We're talking about it in our office. We're talking about our fee structure to help them. And we were well within the 6 digits to help them get a plan in place to solve for this need. And we were getting sticker shock looking at our cost. And one of my managing directors said in the office, he sat back, he said, you know what? If they would have done this, a little bit of this since they started the business, it would have cost them $10,000 to $20,000 a year versus a number that's well over a 6-figure number, because not only have they not done the planning, but they're trying to condense all this planning in a very short amount of time. How do you know you need a plan? I'll give everybody a quick quiz. If you answer negative to any of his answers, you need a plan. Have you defined your personal goals and vision for the transition of ownership and management? Is your successor identified and in place? Have you considered the importance of family involvement in leadership and the ownership of the company? We are getting extremely excited about this industry due to the fact we're starting to see family come into this business, family come into these firms. It is becoming family-owned businesses. We are excited about that at Gladstone. Are you currently using techniques to maximize value while minimizing taxes? This is not a gross game. I do not care what an advisor believes they can sell the business for. At the end of the day, what entrepreneurs care about is what they take home, their net number. If you can build a plan over time that focuses on what you need, not versus what you want, your transition plan will go a lot smoother. Do you have enough liquidity to avoid a forced sale of your business? Meaning, have you built a separate asset base outside of your company that is equal to or close to the value of your business? Do you have a contingency plan should you die or become disabled? Have you considered alternative corporate structures or share transfer techniques to help you achieve your succession goals? The only note I'll make on this page, we work with C corporations, limited liability companies, S corps. If you are a sole proprietorship, you do not have a corporate structure. Meaning at the end, when you pass away, if there is an event, the business will die with you. You do not have equity to transition. Are you dependent upon your firm to meet your retirement cash flow needs? Have you had your business valued recently? Businesses should be valued once every 3 years. In the interim, every year, you should be reviewing the value and updating it. And whatever value a firm like Gladstone would put on your business, we tell firms, and if you go to anybody and say, what is my firm worth? I'm thinking about selling it or transitioning it. That is the value. That is not the purchase price. The price is what somebody is willing to pay for that business. The value gives you your baseline. Action steps. First, we need to recognize we need a plan. Second, as entrepreneurs, it's very difficult to think about, but change is inevitable. Spend the time to know what you're getting yourself into. Think about determining how, when, and to whom you're going to leave the business. Treat succession planning, please treat succession planning as part of your strategic planning process. Look at your corporate structure, think of your successors, but more importantly of all this, determine who you are and what you want to be outside and beyond the business. Begin to write the second chapter for your life. That is all I have. I hope everybody took a little bit of value out of this discussion. Kevin, I'm going to throw it back over to you.
Okay, thanks, Paul. Appreciate it. Well done. A lot of information there. And remember, everybody, if you have any questions, feel free to put them in the questions section on the GoToMeeting app or GoToWebinar app. In the meantime, if you can take a few seconds and choose all that apply here. So this is going back to Paul's question about no planning is, or lack of a plan is, whatever that statement was that he had earlier was fabulous. So formal succession plan, emergency continuity plan, technology disaster recovery plan, and a natural disaster recovery plan in case your business or your business location gets taken out by a natural disaster. So choose all that apply, and do a few seconds to do that, and then we're going to switch it over to Terry, who is excuse me, going to give us a quick overview of the upcoming or the Truelytics evaluation platform. And looks like everybody's jumped in and gone ahead and done that poll. So I'm going to close that and hand this over to Terry. Thanks very much. I'll share the findings with you in a few minutes.
That's great. Thank you very much. I'm going to just take a second here and share my screen when I can. Good afternoon, everybody, and welcome. If you've been listening attentively and been doing other stuff and can focus, I'm just going to walk you very briefly through, and it should only take 5 or 7 minutes. We may go a couple minutes over, to show you the value of the Truelytics software that can help you with some of the things that Paul has been talking about, but more importantly, even many more things in helping you with your business. Before I jump in, just a statistic that I heard recently. Cerulli did a study from advisors, and they said that 35% of advisors, actually the advisor said, this self-reported, that 35% of advisors plan on retiring in the next 10 years. It's a staggering number, and it's an incredible amount of assets that will be in transition over the next decade. Unfortunately, many advisors don't have a plan for succession. That was one of the reasons we wanted to have Paul on here and get you thinking about that. But more importantly, they don't know how to value their firm, what the value should be, where to start, and probably most importantly, what drives that and how that can grow and go up by doing certain things. And that really is what brings us to the Truelytics software as a service platform. And our goal at Truelytics, our mission is to help advisors, small business owners in wealth management maximize what they've built over the course of the last decade, 2 decades, 3 decades, to run their business as a business, not thinking of it as a book or a practice, but thinking of it as a business, and to do it by giving them information through metrics and benchmarking that allows them to make smarter business decisions. But all of that has to start with an evaluation of your business. So what Truelytics platform does is it allows you to get an evaluation of your business that includes a value of your business. It will take about 20 minutes to go through. We ask you information on your firm, your ownership, your advisors, your clients, your processes, your revenues, and your financials. Very quickly, I'll just highlight a couple as you go through so you would know what we'd be asking you for. Obviously when you were started, how you're structured, how many owners and advisors there are, other staff, some information around your custodians and broker-dealers if you're duly registered. If there's more than one owner, we will capture that information. Same thing with advisors. And then we get high-level information on your clients. How many do you have? What's your AUM? Average client age? How many years have they been with you? How many do you add and lose each year? All of the questions that we ask will go into driving what the valuation is on a discounted cash flow valuation basis, which we believe is the best measure for wealth management firms, particularly wealth management firms that have really created businesses, that have recurring revenue. And as Paul mentioned briefly, and we did a webinar on this last week, discounted cash flow is looking at how predictable, stable, is that future cash flow, and then discounted back for the risk premium and interest rate that would be placed on that future cash flow. All of these questions go into that. So then we'll ask questions on your processes, some of which is around continuity plans, succession plans, retention plans. What technology usage are you using? All of these things are important, not just for succession, but also for really making sure that you are maximizing what you're doing in your business, particularly if you're looking to grow inorganically by bringing in others that technology may not match up. Then we get information on your revenues, what your growth rate is, what's recurring, how it breaks down by product area. Last page is on your financials. So we'll get 5 years of net revenue, which will show us your growth rate over time. And then we capture the line item information on your expenses. We do add backs on owner's compensation and benefits, which will give you your owner's earnings before owner's compensation. And then you hit save and finish, and that gives you your Truelytics score, which is effectively your GPA on a score of out of a 4. It shows you what the discounted cash flow basis is. In this example, it's almost $9 million on a business that has $105 million in AUM, 1 owner, another advisor, and 1 support staff. It shows the P&L and valuation ratios, so you can get very good information and be able to show that and compare that against the industry. And then we show you your business, client, and market stability score with the potential impact that you're leaving on the table for having that letter grade. We also provide you with a scorecard that shows you 40 different key performance indicators that show you where you are potentially losing value. There are 2 areas that I would just really quickly highlight. One is around non-competes and succession planning, those things. If you don't have those in place, they typically will take away value. If you were going to buy someone's business that didn't have non-competes with their employees, you would discount that and probably not pay as much because there's risk to those assets and revenue. On the other side, one of the biggest areas that we see is most people rely on referrals exclusively, and that tends to take away value. The last screen that I'll show you before throwing it back to Kevin and wrapping up is we will show you at two places your pro forma, which is the math exercise. It shows you how we get to the discounted cash flow valuation, but also we will share other methodologies that the industry has looked at to give you basically your Kelley Blue Book or range of your potential value. Again, any business is only worth what someone is willing to pay for it, but it shows you exactly where you will fall, and I am confident that any transaction in a example like this would be within these ranges, well within these ranges. So again, let me just close by saying thank you very much for joining us. Our goal is to help you increase your business, to benchmark and be able to look at your business in a way that you haven't in the past, and provide you with great benchmarking tools. You today can go in. We just launched our free version, so if you want to go in and get your valuation, you can just subscribe for free. Put in the information and you will get your discounted cash flow valuation, your Truelytics score, and your client market and business stability. We're going to have a series of these that I'm sure Kevin will talk to you about. But with that, I'll throw it back to Kev and let him open up for questions and wrap up.
Thanks, Ter. I appreciate you moving quickly through that. Obviously, there's a lot in there, especially around the idea of the scorecard and the key performance indicators, which obviously are included in the paid subscription, not included in the light subscription or the free version. But that's really where a lot of the meat around the evaluation tool is going to provide you a lot of insight and information. So we have time for just a couple of meetings, or a couple of questions. I will point out, by the way, that Paul's number on succession planning was right on the money. According to our poll, 20% of you have a formal succession plan in place, which is exactly what Paul said. 30% have a emergency continuity plan. 80% have a technology recovery plan, which is very interesting, and 60% of you said that there is a natural disaster recovery plan in place. So time for just like 2 questions because we're running a little bit late. Somebody asked how long it takes to get a succession plan in place. Paul, Paul, did you answer that question in detail, how long it takes to get one in place?
Yeah, I did. I said, you should start planning the day you start your business. But in reality, Kevin, you want to give yourself 3 to 5 years, so it's smooth, it's not overwhelming, and you can really build a good plan because again, succession planning is multiple plans within one umbrella. So I would say 3 to 5 years, but the longer you give yourself, the better.
Excellent. And Terry, this one might be for you. Excuse me. How are the dollar values determined in the scorecard? Are they based on the firm, the size of the firm, the total valuation, or what are the variables there?
The answer is yes to all of those. It really is driven historically based on deals that have been done over time and how people would look at discounting those things. So it is going to have the size of the firm, the revenues of the firm, the complexity of the firm will drive that. But it is in the way to view it. It is going to look at the cash flow and discount it back based on what would the risk to that cash flow because of that area of not having that area is how it would be. Is it an absolute precise scientific number? Obviously not. But what I tell people all the time, and I'll use this as an example and then let you get to the last question. If you knew that if you had two businesses with the exact same characteristics in terms of AUM and revenue, but one's average client age was 65 and one's average client age was 50, would you pay the same amount for both of those businesses? The answer is obviously not. One has more risk because the clients are older. If one had 100% recurring revenue and one had 65% recurring revenue, but the same top line, would you pay the same? No. So each one has a different, it may not be as big, but that's how it is calculated.
Terrific. Well, that is, I think, probably wraps up the amount of time we have for our webinar. We've got a few minutes over. I appreciate everybody sticking with us, and by the way, most people did, and that's always great news. I hope you found that this webinar was helpful and compelling. And we do have some additional ones coming up. So this next poll is asking sort of your perspective and how often you would like to participate in a webinar. And I'm sure it depends on the type of topic that we're coming up with. As I mentioned earlier, our next one is going to be on the M&A process in the financial advisory marketplace and how that is shaping up and the types of things you can take into consideration during the M&A process, which of course is intimately related to succession planning. So we'll keep you in the loop about when that's coming up. And in the meantime, thank you for voting on this last poll about how often you would like to participate in these. And looks like a lot of you are saying every other week or once a month, which is sort of what we were thinking as well. So we will make sure that we're going to get these out for you in a timely basis and make sure we try and add as much value to as we can. So I'd like to thank Paul for his time today and for his insights on succession planning. And I'd like to say thank you to Terry for giving us a great overview of the Truelytics tool. And for those of you who would like to schedule an online demo to go into more depth on the tool, because I know we had to rush through it a little bit, please feel free to go to truelytics.com. There is an easy form to jump onto to be able to schedule a demo. We'd love to be able to talk to you and give you a little bit more detail on that and see if we can't get you up and running and get evaluation for your business and some benchmarks so that you can start identifying ways to improve. So thanks to both of you again, and everyone have a great day. We appreciate you joining us. Take care.